You may have heard rumors that analysts are expecting a recession in the next few years. While reasons range from high debt levels to aggressive fiscal policy, there's one signal commonly referenced that's a little tricky to understand: the yield curve. While this indicator may look simple enough, there's a lot to interpret from it, and for many, they don't like what they see. Interested? We'll dive into the topic and more on today's Plain Bagel. If you follow the markets, you've probably heard analysts referencing something called the yield curve when discussing the economy. Maybe you've even had a chance to see the elusive curve itself, or perhaps you have no idea what I'm talking about. Regardless, the yield curve has been under the spotlight recently, so it's probably worth taking the time to understand. After all, if you're to believe it, following the yield curve may help you predict the future. Sort of. You see, it's widely believed that the yield curve is a leading indicator, and that certain movements in its shape are signals of bad news to come. But before we get into the advanced stuff, let's break down what the yield curve actually is. When we talk about yields in investments, we are referring to how much an investor is being paid from their investments as a percentage of the holding's value. With stocks, you have your dividend yield, which is your dividend paid divided by the stock's price. But for the yield curve, we're actually referencing bond yields, so the interest or coupon payment of a bond as a percentage of its price. If a bond pays a coupon of $60 a year, it's trading at $1,000, its yield is 6%. The yield basically tells you how much money your money is generating. But because it's based on an investment's price, it changes with the value of the bond. If the bond goes down to a price of $950, then the yield goes up to 6.3%. Obviously, this doesn't mean much if you hold your bond to maturity, but if you sell your bond, this will make it more attractive to other investors, ignoring everything else. After all, they're receiving the same dollar payments as you were, but paying $50 less to receive them. Alternatively, if your bond goes up in price, then it will become less attractive, an important point that we'll touch on again later. But that's the yield part. The curve part comes in when we take a series of bonds and graph their yields. So let's draw our two axes and put yields on the y-axis. On the x-axis, we'll put our bond maturities, which refers to how long the bond in question is outstanding. Bonds are our debt after all, and like most debts, they need to be paid back at some point. As for which bonds we take the data from, we can use any series to create a yield curve, but if we want to get the yield curve, the one all the journalists are talking about, well then we've got to use US Treasury bonds, which are bonds issued by the US government. So if we take Treasury bonds from a variety of maturities and plot their yields, we end up with a curve. Now, the shape of the yield curve is very important. You'll notice that it's upward sloping, meaning that longer-term bonds pay investors higher interest rates. There's a number of theories as to why, but I'm only going to highlight one: the liquidity premium theory. The idea here is that longer-term bonds pose a higher risk to investors than shorter-term bonds, as they tie up your money for a longer period of time, over which a negative event may impact the value of your bond, or a more attractive investment may arrive. For example, let's say you have two investors, one who buys a 2-year government bond and one who buys a 10-year government bond. And let's say that after a year and a half, the government starts issuing higher interest rate bonds. While this would hurt the value of both outstanding bonds since they are now less attractive, the investor with the 2-year bond wouldn't be too concerned. Even though the market value of their bond has fallen, they'll get back the full par value of the bond, the amount borrowed by the government, in 6 months when it matures. Whereas the 10-year bond investor will have to wait longer, even though there's now a more attractive investment option. While the 2-year bondholder can move into the more attractive investment earlier, the 10-year bondholder will have to either sell their bond at a discounted price or wait 8.5 years, accepting a lower return all the while. So, longer-term bonds offer less optionality to investors, and as a result, they tend to pay investors a liquidity premium coupon rate to compensate them for the added risk. This is what causes the upward sloping yield curve, which is known as a normal curve. So, all in all, the yield curve is pretty straightforward. It simply visualizes the difference in interest rates between different bond maturities. In fact, it's so simple that some people don't even use the whole thing, reducing it instead to a single number, known as the yield spread, which is the difference between the 10-year and the 2-year Treasury bond yields. So, if the graph is so basic, why do people care so much about it? Well, here's where it gets interesting. The yield curve doesn't always look normal. Sometimes it changes shape. For example, the curve from time to time has been known to flatten, and when that happens, investors tend to believe a recession is on the horizon. To understand why, we first need to understand how. Naturally, a flat yield curve can be caused by either the short-term yields increasing or the long-term yields falling. The Federal Reserve has a lot of influence on the left side of the curve, but the right side is harder to control. After all, if the Fed increases the coupon rates of the bonds, it will take a long time for all outstanding long-term bonds to mature and for the new rate to reflect in the yield curve. But there is something that can cause the right side to move very quickly. Remember, there are two parts to the yield equation: the bond's coupon payment, which is based on the Fed's interest rate, and the bond's price. And if people start demanding more long-term bonds, it will cause prices to increase. So if we see more people buying on the right side of the curve, it will weigh down long-term bond yields, causing the yield curve to flatten. Now, here's why this is a bad thing. With a flat yield curve, investors have bought long-term bonds to the point where the yield is no more attractive than that of short-term bonds. In other words, investors believe that there is some greater risk out there that outweighs the risk of longer-term bonds. This could be because they expect future interest rates to fall and are rushing to secure current rates, or because they expect other investments to perform poorly. Both of these come from expectations that the economy is going to slow down, whether it be because of slowing consumer demand, rising debt levels, or some other economic data point. Regardless of the reason, investors are rushing into long-term government bonds. And if the situation doesn't improve, it could actually push the yield curve into an inverse position, where concern over the economy is so great, investors are accepting lower returns just to ensure that they have a long-term source of interest. But that's a lot of theory to extrapolate from a simple, dumb graph. And just because investors are worried about the economy doesn't mean we're about to enter a recession, right? Well, here's the crazy thing. History seems to back up the predictive power of the yield curve. If we look at the yield curve for the 3 years leading up to the 2008 financial crisis, well, you can see a pretty clear trend in the shape of the curve. Same thing goes for the 2000 tech bubble. While it's a little more gradual, come 2000, we're seeing 3-month bonds offering the same yield as 30-year bonds. Part of the reason for this is that the flat yield curve is somewhat self-fulfilling as a negative indicator. As the curve flattens, it hurts the profitability of financial institutions and can make access to capital difficult for corporations. So, the reason why people watch the curve so closely is that it essentially gauges investor expectations. And if history is to repeat itself, we can predict an impending recession. Which leads us to the obvious question: what does the curve look like today? Well, there's no need to panic. Here's the curve as of July, and as you can see, it still looks normal. But with policy rates on the rise, it has been flattening, which naturally has people a little concerned. So, are we entering a recession? Should we sell everything and board up the windows? Well, probably not. The yield curve is far from an exact science, and the flat curve could come 3 months or 3 years before a recession. Not to mention, we could easily see it expand again moving forward. Even the implications of flat and inverted yield curves are up for debate. That's the thing about economics. It's ever-changing and full of differing schools of thought. Not to mention that what has happened in the past probably won't recur perfectly in the future. So while we can hedge our risk, trying to pinpoint the next recession and timing the markets is often a bad call. What should you do with this information if not try to avoid a recession? Well, the best approach is to make sure your bases are covered. It's possible that a recession is on the horizon, so diversify your holdings, set up an emergency fund, and make sure your investment risk exposure matches your tolerance. Aside from that, there's not much else you need to do if you're investing for the long term. After all, if you hold a portfolio of high-quality stocks, you don't need to worry about the short-term implications of a recession. So, the yield curve is a pretty cool tool, and it tells us a lot about the current state of the economy. But watching it every day probably won't put you any further ahead of other investors. After all, if making money were as simple as watching a single indicator, well, my job would be a lot easier. But with that said, we're out of time. If you like this video, please hit the like button, and if you like what we're doing here, please subscribe. Hit the bell icon to make sure you get notifications about future videos. If you have any feedback or topics you'd like us to cover in future videos, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today.